The spread between the United States 10-year Treasury yield and the 2-year Treasury yield has inverted before every single recession since 1955. This specific metric, the 10s-2 spread, has provided zero false positives during this period. An inversion occurs when the short-term rate exceeds the long-term rate, defying the standard expectation that investors demand higher compensation for locking up capital longer. Historically, once the 10s-2 spread drops below zero, a recession follows within 6 to 24 months. The inversion signals that market participants anticipate a significant economic slowdown, forcing the Federal Reserve to eventually cut interest rates sharply. This expectation drives down long-term yields immediately, while the Federal Reserve's current policy keeps short-term rates elevated. A normal yield curve slopes upward because time equals risk. Lenders require a higher yield premium to compensate for inflation risk and uncertainty over a decade compared to 2 years. This positive slope, where the 10-year yield is significantly higher than the 2-year yield, indicates healthy economic expansion and expected future growth. When the curve flattens, the difference between short and long rates narrows, suggesting growth expectations are moderating. The moment the curve inverts, the market is pricing in a future where short-term borrowing costs will be dramatically lower than they are today. This only happens when the market forecasts a severe contraction in economic activity, requiring aggressive monetary easing to stimulate demand. Inversion directly impacts the banking sector, which relies on borrowing short and lending long. Banks profit from the positive spread between short-term deposit rates and long-term loan rates, such as mortgages. When the yield curve inverts, this profit margin disappears or turns negative. Banks respond by tightening lending standards, reducing the availability of credit for businesses and consumers. This credit crunch acts as a powerful brake on the economy, slowing capital expenditure and consumer spending. Furthermore, the inversion reflects bond traders moving capital into long-term safe assets, signaling deep pessimism about corporate earnings and overall economic stability. The Federal Reserve directly controls the short end of the curve through the federal funds rate target. When inflation is high, the Federal Reserve raises this rate, pushing up the 2-year Treasury yield. Long-term yields, however, are determined by expectations of future growth and inflation over the next decade. If the market believes the Federal Reserve is raising rates too aggressively, causing an inevitable recession, long-term inflation expectations drop. This causes the 10-year yield to fall, even while the 2-year yield is rising due to current Federal Reserve action. The inversion is therefore a direct conflict between the Federal Reserve's current restrictive policy and the market's long-term pessimistic outlook.
The 1981 recession, triggered by Federal Reserve Chairman Paul Volcker fighting inflation, saw a deep inversion preceding the severe downturn. Similarly, the inversion in 2000 preceded the dot-com bust and the subsequent recession. Most recently, the 2006 to 2007 inversion provided a clear warning before the 2008 global financial crisis. The average time from the initial 10s-2s inversion to the official start of the recession, as declared by the National Bureau of Economic Research, is approximately 14 months. Crucially, the stock market often continues to rally for several months after the initial inversion, creating a dangerous period of false confidence for equity investors. After the yield curve inverts, the stock market typically enters its final euphoric phase, often referred to as the blow-off top. This period can last 6 to 12 months, characterized by high volatility and sector rotation. Historically, defensive sectors like consumer staples and utilities begin to outperform cyclical sectors like technology and industrials during this phase. The actual peak of the stock market usually occurs when the yield curve is still inverted, but the recession officially begins shortly after the Federal Reserve starts cutting rates in response to economic weakness. Investors must recognize that an inverted curve signals preparation for the inevitable downturn, not immediate selling. During an inversion, short-term bonds offer higher yields than long-term bonds, making short-duration fixed income highly attractive. Investors can capture higher current income while minimizing interest rate risk. As the recession approaches and the Federal Reserve begins cutting rates, bond prices rise significantly, especially for long-duration bonds. The inversion period is often the optimal time to gradually shift capital from short-term bonds into long-term Treasury bonds, anticipating capital appreciation as yields fall during the subsequent economic contraction. Corporate bonds, especially high-yield debt, should be avoided due to increased default risk during the recessionary phase. The duration of the inversion matters significantly. A brief, shallow inversion is less concerning than a deep inversion lasting several quarters. The recession typically begins after the yield curve uninverts and steepens rapidly. This steepening occurs because the Federal Reserve is aggressively cutting short-term rates to combat the recession, causing the 2-year yield to plummet below the 10-year yield. This rapid steepening, often called a bear steepener, confirms the recession is underway and signals the worst period for corporate earnings and employment. The market bottom usually occurs when this steepening is most pronounced. When the 10s-to-2 spread is inverted, investors should prioritize capital preservation and liquidity. Reducing exposure to highly levered companies and cyclical industries is prudent. Increasing allocations to cash equivalents, such as Treasury bills, provide safety and currently superior yields compared to longer-term instruments. Consider hedging equity portfolios using inverse exchange-traded funds or put options to protect against the anticipated market decline. Focus on companies with strong balance sheets, consistent free cash flow, and inelastic demand for their products, as these sectors historically weather recessions most effectively.